Hello and welcome to a new video of the Polynomial Academy, a series where we will discuss the most important crypto trading and DeFi concepts. Quick question. Have you lost a lot of money due to decrease in price of a single crypto? If yes, then even you are at fault because you don't follow risk management. Don't get me wrong. Constantly changing crypto prices will obviously lead to small losses sometimes, and that's just a part of crypto trading. But avoiding big losses is up to you, and risk management helps you do just that. In today's video, we will understand what is risk management and share the best practices for it while trading crypto. But here's a good practice that you should follow every time: liking the videos from this channel that you find really useful and subscribing to the channel. You should get started with that practice right now, and we'll start this video. We can't get to risk management without talking a little about risk first. Risk is the possibility of something unexpected happening to you, very different from what you had initially planned. For example, meeting with an accident while driving back home is a form of risk. Reaching home safely was the expected outcome, but the possibility of having an accident instead is the risk we take every time we step out and drive. While in crypto trading, the possibility of losing money on a trade instead of earning profits is the underlying risk. Risk management starts with the acceptance that markets are never under our control and none of us know where they are going to go next. All we can do is increase our odds of survival whenever market goes against us. Going back to our earlier example, airbags opening up in case of an accident and having an insurance for ourselves and our car is form of risk management. Meeting or not meeting with an accident is not up to us, but you can always try to reduce the injuries if you do face one. Similarly, rise or fall in the price is not up to you, but you can always try to restrict the loss in case of a price drop. To conclude, risk management is everything you do to handle the situation when something unexpected happens. The aim of risk management in crypto trading is to make sure that no matter where the price goes, your losses shouldn't become too large to recover from. So what are the best practices while managing risk? First up, there's diversification and hedging. Most of you would already know this famous quote that don't put all your eggs in one basket, which advises people to distribute their money across various investments. While this is more relevant for long-term investing, even traders should ensure that majority of their trades are not into tokens of a single category like DeFi, gaming, metaverse, etc. This would ensure that a sudden negative news about a particular category does not lead to losses in multiple open trades. Hedging is another way of managing risks where a new trade is taken to offset an existing trade. This is usually done by entering an opposing trade of similar size as the original trade. Crypto traders use various hedging methods for their futures position, including buying actual tokens in the spot market to hedge their short trades, or different option strategies which combine futures and option trades to reduce risk. Next up, we have position sizing. Now, trading is usually fast-paced and high-stakes decisions need to be made really quickly. This leads to many traders having FOMO. FOMO, or fear of missing out, means taking decisions driven by greed or fear that others will make money on a particular trade while you will be left behind. It often leads to losing discipline and using a large portion of capital in a single trade for quick profits. And even if one such trade goes south, there can be massive loss. This is why position sizing is very important. It involves determining how much capital to use for a specific trade from the total available capital. While there are a lot of methods for calculating position size of a trade, the 2% rule is perhaps the most popular one. This rule states that you should never lose more than 2% of your total capital in a single trade, regardless of the quantity traded. So if your total capital is $10,000, you should not risk more than $200 per trade. The actual quantity to be traded needs to be calculated based on the stop loss level and leverage for that particular trade. Let's take an example to understand this better. Say you decide to go long on XYZ Perp, which is trading at $100, and you take 2x leverage for this trade. You also figured that $96 will be a good stop loss for this trade. After back calculating based on the 2% rule, you can trade 25 contracts of the XYZ Perp for this trade. Number 3, take profit and stop loss orders, or TPSL orders. Like I mentioned earlier, Taking trades based on emotional decisions is a very common cause of large losses. The best solution for it is to rely on automation instead of your own emotions. TPSL orders help you do exactly that. Both the orders instruct the exchange to exit a trade at a certain pre-decided price level. The only difference is that the trade will be exited in loss at a price below the entry level in case of stop loss orders, whereas it will be exited in profit at a price above the entry level in case of take profit orders. Stop loss orders let you limit the downside, while take profit orders are for locking in already earned profits. Polynomial protocol has various order types available, including the TPSL order, which is not commonly available on other decentralized exchanges. Lastly, risk-reward ratio. All of us know that losses are an unavoidable part of trading since every trade can't be profitable. But if we keep losing all the profits we've made after every few trades due to losses, then our overall funds will never grow, right? A good risk-reward ratio is the answer to just that. It is the calculation of how much potential profit can you earn for every dollar of risk you take in a single trade. For example, you enter a trade at $100 with a stop loss at $95 and target set at $115. The max loss per contract is capped at $5, but the potential profit is $15, resulting in a risk-reward ratio of 1:3. With this ratio, even if one successful trade is followed by two loss-making ones, you would still be left with $5 in profit. This is how skilled traders remain profitable over the years despite loss-making trades. I'd like to leave you with a quote that truly brings out the value of risk management. Rome was not built in a day, but Hiroshima was destroyed in one. Always remember that a single unrestricted trade can erase profits generated over years of effort, and risk management helps prevent that. Polynomial Academy will keep bringing videos which are more and more useful for you in your trading journey. So subscribe to the channel and press the bell icon to avoid missing out. I'll see you in the next one.